So do you want to pay ordinary income tax, Julie? And do you want to pay capital gains tax roughly, 40% or no?
I don't want to pay any of those taxes.
Okay. Right. And so what are the steps, right? Number one, we've got to develop a plan and we've got to develop a team and a couple strategies, right?
How are we going to approach our sellers and present this concept to owner operators who they want to retire, they want to exit, and they need this level of education? Because you and I think we can agree that it's truly a level of education and it's a lack thereof. And it's about doing that adequately and effectively. So can we just give me let's pretend I'm the owner. And what would you say?
Absolutely. So the first thing, Julie, I would say is you got to have a mindset of tax flow and not just cash flow, right? Most folks, the challenge is they're so caught in the cash flow. They're so caught in the day-to-day. They're like the operator who's been operating that 150 unit, assisted living facility, memory care. And that's all they ever know is just cash flow, cash flow, cash flow. And they're about to exit this thing for $15 million or whatever it's going to exit for. And everything is tied up to selling it and or cash flow. And what they fail to prepare for and plan for is the tax flow, which is the capital gains tax flow, what's going to happen with the tax. And that tax is really somewhere between 25 and 50% of your gain, which is amazing to think about, right? You bought something for $1 million or $2 million 25 years ago, you fully depreciate it. It's now worth $15 or $20 million. And you're about to get wiped out between 25 to 50% of the proceeds. So first thing, understand it's a tax flow mindset, and you've got to prepare and you got to build a capital gains tax exit plan. And that's the key. You want to have a business plan for the taxes, right? It's like its own separate, plan. And ideally you're building that plan prior to even listing the building, right? Prior to obviously selling the building. I mean, you need to, because the IRS has these certain things that hit. So I'd first say, Julie, what are you selling? And maybe let's use a $10 million deal. And let's just say you own it. Where do you own it, Julie?
Wisconsin. We love the Midwest.
Okay. All right. I think they have like a 5% per year. 5% for cap gains tax, right? And then there's 20% federal. So now you're at 25. Then you have 3.8 Obamacare. So now you're at about 29. Then you have depreciation recapture. So let's just say 33%, right? Let's just say that's the number. I don't know if Wisconsin is 5%. I don't have it in front of me, but on that scenario, and imagine you had a zero basis. Now, do you have any debt on the building?
Yeah, we still owe $5 million.
Okay.
Well, $10 million assets. So let's say we've bought it down. We owe $3 million.
Okay, you owe about $3 million, okay? And then it's a $10 million asset. But let's just assume your basis is zero, right? You've owned it for many, many, many years, right? So keep it simple for our math purposes on here. And so if you did nothing tomorrow, you're going to be faced with about 33% of the $10 million gain, which is $3.3 million of tax. You see how I got that? 10 minus zero is 10 million is a $10 million gain, right? From zero basis. And so you're going to have about 3.3 million of tax. And so that's your first big problem to solve for. You see that?
I see that. I totally see.
Now you also have a debt over basis challenge, Julie, right? And debt over basis, we've been taught, hey, cash out refi, it's amazing. You get all, this tax-free money, but that can catch up to you if the debt is over the basis. So in this scenario, you had 3 million of debt, that's going to be taxed ordinary income tax. So that's even worse. So not only is it 33%, it's probably more like 40%. That amount or more. So that's going to be even crippling, that difference between 3 million and zero basis. Okay. So do you want to pay ordinary income tax, Julie? And do you want to pay capital gains tax roughly, 40% or no?
I don't want to pay any of those taxes.
Okay. Right. And so what are the steps, right? Number one, we've got to develop a plan and we've got to develop a team and a couple strategies, right? So we've identified the problem. Now we got to identify what strategies are going to solve that problem. And this scenario, we're going to prescribe two solutions. And because you're in investment real estate, we're going to do a partial Delaware statutory trust, because the Delaware statutory trust can replace the debt over basis. We're typically going to do a zero coupon deal. And the zero coupon deal is going to be able to replace the debt. Remember what I said earlier in this video, and I said they're going to replace the debt. So one of the Achilles of the deferred sales trust is it can't replace debt, and also it also doesn't require debt, but it doesn't replace the debt over basis. So we have to replace that debt over basis. And so this is something where we're going to use two DSTs. So first, we're going to send all of the proceeds at close of escrow to a qualified intermediary. You know, work with us on this because we work with a qualified intermediary to have all of this smoothly laid out. And we're going to do a partial Delaware with that 3 million over base, 3 million debt over basis, which is typically about 20% of that 3 million. So some of your equity will go to that. But guess what, Julie? Now the debt's out of your name, it's replaced, and then the remainder can go into the deferred sales trust. And so you're debt free, you're diversified, you have some liquidity, and you have optimal timing. And that's just a quick prescription of this. And any questions so far on that?
No, I love this. So now I'm looking at, and I'm not good with knee-jerk math, but I'm like, I was probably going to walk away with basically $1 million, maybe $1.5 million. And now with this, I'd love to know what the difference is between what I would have walked away with had I not utilized a strategy like this versus, okay, we use the strategy and boom.
Right. And so we'll do the 10 million. I'm going to use 4 million as the liability just because you have some debt over basis. So you would have had 6 million, but you would have paid off the debt of 3 million. So now you would have about 5.7 million not doing anything, right? Just paying all the tax. In this scenario, I think we would just add back the 4 million. Oh, I'm sorry. Let me do 10 million. And we said we had 3 million of debt, right? So that would have been 7 million. Then you would have paid about 4 million of tax. So that would have been 3 million. Instead, you're gonna have about 7 million, right? Now we're gonna have to put some of that money on the 3 million debt over basis, about 20%, about 600,000 would go into the Delaware statutory trust. So you'd have a interest in a Delaware, small interest. It's a zero coupon deal, not a lot of cash flow, but it replaced the debt. So that's 600 there. This 10 million minus the 3 million. So you got 10, 3 million. Now we're at 7 minus the 600,000. So you'd have about 6.4 million. Let's just say closing costs. Let's just say 6.2, just to keep it simple. 6.2 million in the trust is the second outcome, right? What did I say on the first one? It was like less than that. So it was like,
it was horrible. I mean, like,
3.
honestly, it's traumatic. I'm like, I don't even want to think about it.
Yeah, I think it was 3 million versus 6.4, right? So it's substantial. It's huge, right? That's the difference there. And now all that money can be invested into one of Julie's deals, right? Which is cool. It can be invested into my own deals if I want to do my own. It could be go into hard money lending. It can go into the stock market. You can go into a diversified portfolio, but you're debt free. You're diversified. You've got an extra, let's say $3 million working for you. And you're probably feeling pretty good.